Hello everyone and welcome to the Mortgage Rundown. I'm Jason Obradovich, Executive Vice President of Capital Markets for New American Funding. Today we're going to talk about inflation. There are many different measures of inflation. The most widely used measure of inflation is CPI, the Consumer Price Index. Inflation indexes are calculated by taking a basket of goods and monitoring the price change over time. If the price of those items go up, then so does the index. The FOMC's preferred inflation index is PCE, the Personal Consumption Expenditures. How does this all relate to the market today? The graph on your screen in blue is core PCE for the past 36 years. The red line is the Fed's current inflation target of 2%. Note that inflation has been mostly below 2% since 1996. For over 20 years, inflation has been contained despite interest rates dropping over the same time period to record lows. This country hasn't seen real inflation since the 70s. Mortgage rates have moved higher since the election on inflationary fears based on the expectation of growth. Those fears plagued the market and created this belief the Fed needs to act now to prevent runaway inflation by raising interest rates and would need to do so 4 times in 2017. I think it's pretty clear from the graph that inflation shouldn't be a major concern. It's very unlikely it will rise at an uncontrollable pace, and if anything, there should be a fear with rates this low, why isn't inflation moving higher? Most recently, the failure to pass healthcare overhaul and the likely failure on passing tax reform should give the market more confidence that inflationary fears are overblown. With that, rates have come down in the past week with the 10-year currently at 2.36%. If tax reform fails, we could test the bottom of 2.3%. Also, if oil prices start to fall again below $45 to $50 a barrel, it's very reasonable to expect the 10-year could break the bottom of the range and test 2.15%. Looking ahead, there are some key things to watch. Tomorrow is the non-farm payroll report, and the market is expecting 175,000 jobs added with an unemployment rate of 4.7%. Next week is inflation figures for PPI and CPI. Even though they aren't the Fed's preferred measurement, they are important. And as always, keep an eye on the headlines related to legislation and Europe. If you'd like a more in-depth analysis, please visit our blog. You can find the description or this button here. Thanks for watching and have a great day.